Welcome to the deep dive. We cut through the noise, get you those core insights you really need. Today, we're unpacking a really interesting stack of analyses, all looking at the current economy and, well, the market landscape.
Yeah, exactly. The source material today, it's a series of recent pieces from Fundamental. They offer some pretty timely takes on, critical financial topics. Our job here is to pull out the most important nuggets for you. Okay, let's dig in.
All right. First up, Fundamental's piece called Investor Rotation. This one caught my eye. They're pointing out something fascinating. The big institutional investors, they're selling. But retail investors and corporations, they're actually buying, especially companies buying back their own stock.
Yeah, and often at high valuations too.
Exactly. Fundamental calls this a supply squeeze.
Yeah.
So what's the big deal here?
Well, it's kind of a classic contrarian signal, isn't it? You've got the, let's say, sophisticated money heading for the exits, while maybe less experienced players, often driven by optimism, are jumping in. That's, well, historically not always a great sign.
Right.
Like the institutions might be de-risking, sort of building up cash reserves, maybe preparing to step in if things get shaky.
Yeah.
Act as liquidity providers if the market corrects.
So like waiting for a better entry point.
Potentially, yeah. So for you, it's definitely a signal to watch who's holding, what if or when conditions shift.
Interesting dynamic. Okay, speaking of big shifts, Fundamental also looks at the plan. This is about the White House's U.S. AI action plan.
Ah, yes, the AI plan.
It seems to have three main pillars: speeding up innovation, building out domestic infrastructure for AI, and leading the global diplomacy side of things. And it's clear the private sector, especially the big tech hyperscalers, they are just pouring billions into AI supercomputers.
Billions, yeah. And the source makes this quite an intriguing comparison, actually.
Yeah.
They compare the current AI push to Y2K, which, thinking back, really helped kickstart the internet boom in many ways.
Huh. Y2K. Didn't expect that comparison.
Me neither, but it makes sense in terms of investment spurts. The source notes AI has maybe a clearer technical path forward than the early internet did. But here's the kicker. They raise a really critical question about the social impact, specifically wealth concentration. Will AI widen that gap?
That's a huge question. Okay, let's pivot then to market sentiment. The source, complacency. Equity markets are hitting all-time highs, right? And Fundamental suggests there's a big dose of complacency settling in.
Definitely feels that way sometimes.
They also mention the Buffett indicator, that's the total market cap of U.S. stocks versus U.S. GDP, is also at an all-time high. And historically, that indicator often comes back down, sometimes, well, with a market correction.
Exactly. And while AI could be a genuine paradigm shift, the source argues that investor expectations, they tend to get ahead of themselves, right? Stretching way beyond rational scenarios sometimes. So Fundamental suggests that this kind of euphoria usually means a correction is needed just to normalize things.
Like a reality check is due.
Sort of, yeah. Like stretching a rubber band too far eventually, it often has to snap back a bit.
Right. So looking more broadly then, with what lies ahead, what's the bigger picture for the U.S. economy? We've got these high equities, inflation year on year looks contained, but prices have really added up cumulatively.
Yeah. The cumulated price increases, yeah, that's key.
And this global sort of pivot towards nationalism. What's Fundamental's take on where we're headed?
Well, their analysis suggests the sort of dream scenario, high growth, low debt costs, markets roaring. That's probably unlikely.
Okay, so what is likely?
They argue the most probable path is actually stagflation. That's that nasty mix of high-ish inflation and slow, sluggish growth. In that scenario, debt burdens could push interest rates up, which tends to pull money out of equity markets.
Stagflation. Yeah, definitely not the ideal outcome. Which brings us neatly to monetary policy and decoupling. Fundamental touches on concerns about potential political influence over the Federal Reserve's independence, specifically mentioning President Trump.
Yeah, this is a really critical point they raise, kind of a fork in the road. If the Fed stays independent, you might see them stick to their guns, maybe keep hiking rates to combat any sticky inflation.
Well, yeah.
But if the White House were to exert more control, Fundamental suggests the path could be lower rates, but that likely means higher inflation, which is obviously a big problem for price stability and, for anyone holding assets sensitive to inflation.
Huge implications there. Okay, now this next one, inconvenient truth. This is where Fundamental gets really interesting. They point out that the Bureau of Labor Statistics' main jobs report, the non-farm payrolls, for March to December 2024, apparently it overstated job growth. by nearly 800,000 jobs.
Wow, 800,000. That's significant.
It is. And they compare it to the QCEW data, which covers almost all employers, and that data showed a figure 57% lower. That's a massive difference.
It really is. The takeaway from fundamentals is that we might have been working with job numbers that were, quote, severely overstated.
Mm.
And they don't stop there. They also float the idea that inflation numbers might have been artificially softened.
Softened how?
Well, partly by things like owner's equivalent rent. That's the BLS's estimate of what homeowners would pay in rent. It's a big component of inflation measures. The source kind of provocatively notes that this potential error, both in jobs and inflation, is quite convenient, let's say.
Convenient for painting a better economic picture.
Potentially, yes. It raises serious questions about the data guiding policy, doesn't it? Makes you wonder what numbers you can really trust.
Absolutely. Okay, finally, let's look ahead with second wave. What's fundamentally coming for inflation down the road?
They point to a few big drivers. This huge expansion of the global money supply, ongoing wars, tariffs cropping up, continued government spending. All these things, they argue, are contributing to what they expect will be a second wave of inflation.
A second wave, after we thought maybe it was cooling off.
Exactly. And the core idea here is the debasement of fiat currencies.
Yeah.
Government money not backed by gold or anything physical. When you create a lot more money or spend a lot more without a matching increase in actual goods and services, each dollar, euro, whatever, it just buys less.
So currency loses value.
Precisely. And fundamental suggests this helps explain why assets seen as inflation hedges, things like gold and even Bitcoin, keep rising globally. People see them as potential stores of value when traditional currencies might be losing theirs.
Okay, wow. So let's try and wrap this up. What does this all mean for you listening? We've gone through quite a bit shifts in who's buying stocks, the massive AI push, potential issues with key economic data, and this looming specter of more inflation. It's a lot.
It is a lot. It's complex and it's all interconnected, isn't it? And maybe the big question this leaves for you to think about is, how did these underlying currents, these shifts in investor types, the questions around data accuracy, potential policy directions, the future of money itself, how do they shape your view of the bigger economic story?
Yeah, how does it affect your understanding?
Exactly. There's definitely a lot there to mull over. We really hope this deep dive encourages you to keep asking those big critical questions yourself.